Welcome to LuckScout Economic News. Inflation is a term that has been on everyone's lips lately, and for good reason. It's a phenomenon that affects every aspect of our daily lives, from the cost of groceries to the price of gas. Listen up because this is important. Understanding inflation and the Federal Reserve's role in managing it is crucial for anyone who wants to stay informed about the economy. Inflation is still a major concern. When prices rise, the purchasing power of our money decreases, meaning we can buy less with the same amount of money. Prices are higher than they've been in decades. This isn't just a minor inconvenience, it's a significant issue that affects everyone, from individuals to businesses. This is putting a strain on everyone's wallets. When the cost of living increases, it becomes harder for people to make ends meet, leading to financial stress and uncertainty. The Federal Reserve, our nation's central bank, is trying to get inflation under control. Their primary tool for doing this is adjusting interest rates. They've been raising interest rates to cool down the economy. By making borrowing more expensive, they hope to reduce spending and slow down the rate of inflation. Higher interest rates make it more expensive to borrow money. This affects everything from mortgages to business loans, making it more costly to finance big purchases or investments. This can slow down spending and hopefully bring prices down. When people and businesses spend less, demand decreases, which can help to stabilize prices. But it's a delicate balancing act. The Fed has to be careful not to raise rates too quickly or too high, as this could have negative consequences for the economy. The Fed doesn't want to raise rates too quickly and send the economy into a recession. A recession could lead to job losses and further economic hardship. Right now, the Fed is hinting that they might pause their rate hikes soon. This pause would allow them to assess the impact of their previous rate increases. They want to see how their previous moves are impacting the economy. It's a cautious approach, aimed at avoiding any sudden shocks to the system. But don't get too excited. A pause doesn't mean that rates will start coming down anytime soon. They're also saying that rates might stay higher for longer. This means that borrowing costs could remain elevated for an extended period, affecting everything from home loans to credit card interest rates. The Fed is committed to getting inflation back down to their 2% target. This target is seen as a healthy level of inflation that supports economic growth without eroding purchasing power. This is a critical time for the economy. The decisions made by the Fed in the coming months will have long-lasting effects on economic stability and growth. We need to keep a close eye on inflation and the Fed's actions. Staying informed about these developments can help us make better financial decisions. Stay informed and don't panic. Understanding the Fed's balancing act can help us navigate these uncertain times with greater confidence and clarity. We've got another economic challenge on our hands, a widening trade deficit. This issue has been growing steadily over the past few years, and it's becoming a significant concern for economists and policymakers alike. Simply put, we're importing more goods than we're exporting. This imbalance can have far-reaching consequences for our economy. This isn't always a bad thing, but it's something to watch closely. A trade deficit can indicate a strong domestic economy with high consumer demand, but it can also signal underlying issues that need to be addressed. A growing trade deficit can put downward pressure on our currency. When the value of the dollar decreases, it can make imports more expensive and exports cheaper, which might help balance the trade deficit over time. It can also mean that we're relying too heavily on foreign goods. This reliance can make our economy vulnerable to global market fluctuations and supply chain disruptions. There are a few reasons why the trade deficit is widening. Understanding these factors is crucial for developing effective strategies to address the issue. First, the strong dollar makes our exports more expensive for other countries to buy. This can reduce demand for American-made products abroad, further widening the trade gap. Second, consumer demand remains strong here in the U.S., which means we're buying a lot of goods from overseas. This high demand for imported products contributes significantly to the trade deficit. The trade deficit is a complex issue with no easy solutions. It involves a delicate balance of economic factors including currency values, consumer behavior, and international trade policies. But it's something that policymakers need to address. They must consider a range of strategies from negotiating better trade deals to implementing policies that encourage domestic production and export growth. We need to find ways to boost our exports and make American-made goods more competitive. This could involve investing in innovation, improving manufacturing processes, and promoting our products more effectively in international markets. Additionally, supporting small and medium-sized businesses in their efforts to enter global markets can play a crucial role in reducing the trade deficit. These businesses often have unique products that can appeal to international consumers. Education and awareness are also key. By understanding the dynamics of global trade, consumers and businesses can make more informed decisions that contribute to a healthier trade balance. Community engagement and public discussions on trade policies can help build a consensus on the best approaches to tackle the trade deficit. It's a collective effort that requires input from all sectors of society. While the challenge is significant, there is hope. With the right strategies and a collaborative approach, we can work towards a more balanced trade scenario that benefits everyone. Let's talk about the American consumers. Personal income is rising, which is good news. People have more money in their pockets. And guess what? They're spending it. Consumer spending is also on the rise. This is a positive sign for the economy. Consumer spending is a major driver of economic growth. But here's the catch. The personal saving rate is low. People aren't putting away as much money for a rainy day. This could be a problem down the road if the economy weakens. It's important to find a balance between spending and saving. Make sure you're putting some money aside each month, even if it's just a small amount. Inflation is a silent thief that can erode the value of your money over time. But with the right strategies, you can protect your wealth and even grow it. So, how do you protect your hard-earned money from the ravages of inflation? The key lies in making informed and strategic investment choices. You need a smart investment strategy. This involves understanding the different types of investments and how they perform in various economic conditions. Remember, inflation erodes the purchasing power of your cash. This means that over time, the same amount of money will buy you less and less. That means you need your investments to grow faster than inflation just to stay ahead. It's not just about preserving your wealth, but also about making it work for you. So, where do you put your money? Diversification is key. By spreading your investments across different asset classes, you can reduce risk and increase potential returns. Certain sectors and asset classes tend to perform well during inflationary periods. These include commodities, real estate, and stocks. Commodities like oil and gold are often seen as inflation hedges. They tend to increase in value when inflation rises, providing a buffer against the decreasing value of cash. Real estate can also be a good investment during times of inflation. Property values and rental income often rise with inflation, helping to preserve and grow your wealth. And don't forget about stocks. While they can be volatile, stocks have historically outpaced inflation over the long term. Companies with pricing power can often pass on higher costs to consumers, protecting their profits. This makes them a good choice during inflationary times. Look for companies with strong brands and a loyal customer base. These companies are often better positioned to maintain their profitability during inflation. Remember, investing involves risk. It's important to do your research and consult with a financial advisor before making any investment decisions. They can help you create a strategy that's tailored to your individual needs and goals, ensuring that you're well prepared to face the challenges of inflation. The Federal Reserve is hinting that they might hit the pause button on interest rate hikes soon. But they're also saying that rates could stay higher for longer. So what does this mean for your investment portfolio? If the Fed delays rate cuts, it could create some opportunities for savvy investors. Short-term bonds might become more attractive. As interest rates rise, so do the yields on newly issued bonds. High dividend-paying stocks could also be a good option. These companies offer a steady stream of income, which can help offset any potential losses in the stock market. Keep a close eye on the Fed's announcements, and be prepared to adjust your portfolio accordingly. Don't put all your eggs in one basket. That's the golden rule of investing, and it's especially important in today's uncertain economic environment. Global diversification is key to mitigating risk. By investing in international stocks, bonds, and other assets, you're spreading your bets. This can help protect your portfolio from losses if one particular market or region experiences a downturn. Emerging markets in particular offer the potential for high growth, but they also come with higher risks. It's important to strike a balance between risk and reward when diversifying your portfolio. Remember, diversification is your friend. Don't be afraid to venture outside of your comfort zone and explore opportunities in different parts of the world. Despite inflation and economic uncertainty, American consumers are still spending. This tells us something important. there are still pockets of strength in the economy. As investors, we need to identify these pockets of strength and capitalize on them. One way to do this is to look for companies that cater to consumer spending trends. For example, people are eager to travel and make up for lost time after the pandemic. This could benefit airlines, hotels, and other companies in the travel and leisure industry. Keep your finger on the pulse of consumer spending and be ready to pounce on opportunities as they arise. We're living in uncertain times. There's no denying that. Inflation is still a concern. The Federal Reserve is trying to engineer a soft landing for the economy. And the trade deficit continues to widen. But here's the thing. There are always opportunities for investors who are willing to do their homework and stay disciplined. Don't let fear and uncertainty paralyze you. Stay informed about economic developments, review your investment portfolio regularly, and make adjustments as needed. And most importantly, don't panic. The stock market has a long history of rewarding patient investors. Stay the course and you'll come out ahead in the long run. Please like the video and share it with others. Thank you for watching.